Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This show is brought to you by Lumet.com. Check them out for loans for senior housing, for healthcare real estate, for all types of multifamily. They're really experts there. They have people too. They're not just a website. They're available all over the country. Learn more at Lumet.com. Well, today we're going to talk about a sector that's on the minds of really everyone today, and that's the office sector, right? The office sector really impacts the entire economy, municipalities, and the retail and everything around the office buildings. And of course, we've seen occupancy and demand dwindle. We've seen transaction volume slow down, partly because of the spike in interest rates. But what's happening now? How did 2023 end up? What should we expect for 2024? And what are some of the trends to watch out for? Please welcome my guest. It's Phil Mobley. He's Director of Office Analytics with the CoStar Group. Phil, good to see you.
Thanks, Michael. Great to be back.
Yeah, thank you. And so first, let's look at 2023. Kind of everyone knows that most properties kind of suffered a little bit while there were some green shoots. How did 2023 kind of end up?
Well, it wasn't great in the occupancy market in the office sector. In fact, it was, depending on how the final numbers end up shaking out, it was either the second or third worst year for absorption on record. It's interesting that it may not have felt that way because we had our worst year in 2020. Right. But it looks like tenants gave back about 55 million square feet over the course of the year. And that's comparable. It's very close to what we saw in 2009, the Great Recession. And then all the way back in 2001 with the dot-com crash, pretty similar numbers there. Mm-hmm. Difference, of course, is that this time around is the fourth straight year of negative absorption. So we're still seeing this shakeout from the impacts of the COVID-19 pandemic and really the different ways of using office space that have emerged since then. I do think that we may not be quite at the bottom. I think we're in for another pretty similar year, frankly, in 24 in terms of absorption. But I think we can see it from here, right? We're probably over halfway through those pre-pandemic leases that have been rolling over. And a lot of those got extended for a short term in 2020, 2021. Well, now I think the good news is tenants are starting to commit to space for the long term. We're seeing lease terms return to their more or less average pre-pandemic length. Of course, the bad news is tenants are taking less space. So there's actually more of them in the market. If you look at the reports from brokerages and software companies, they'll say there are more tenants in the market, and that's true. We saw the number of leases actually go up in 23, 5, 6, 7% or so over the pre-pandemic norm. But those tended to be 15 to 20% smaller. And so that's been a drag on both absorption and leasing volume. It's kind of the move and shrink on the one hand. And then on the other hand, a lot of smaller tenants who may traditionally have stayed put have decided, hey, we're going to go out in the market and upgrade our space. So I think we've got another year plus of that to shake out. 2024, I think we're going to see more negative absorption. We're going to see increasing vacancy. 13.5% by the CoStar reckoning is how we ended 2023. That's a record in our numbers. It's up about 430 basis points from it's kind of mid-2019, which was the trough. Now, if you compare that to what we might see from a major brokerage or investment manager, they're reporting on really the competitive leasing market, sort of multi-tenanted institutional quality space. We tend to report the whole universe. It's what we do at CoStar. We track everything. So if you sort of apply a similar filter to what you might see from another source, then that 13.5% is probably more like 18% or so in the competitive leasing market. That's a comparable figure. So still a lot to work through in the occupancy market. But again, I do think we're just about to the point where we can see where things bottom out.
Yeah. So do you expect vacancy to increase slightly over your 13.5% then in 2024?
We do. So we saw it go up 110 basis points or so last year. I think we're in for something similar this year, maybe even a little more in 25. We're working on our forecast for 24 right now. I expect that we'll probably see vacancy top out somewhere around 16%, somewhere maybe just north, just south of there. And one interesting phenomenon, though, is I'm actually not sure what that's going to mean for rents. I don't know that it's going to mean what we would think it would normally mean for rents. In fact, one of the surprises of the last 4 years is that, at least on a nominal basis, office rents have stayed pretty flat on an asking basis. About $35 a square foot is kind of the national average. Now, one piece of context is consumer prices are 20% higher than they were in 2019. So that's part of the equation. And office rents are the only commercial rents that haven't really kept pace with that. Industrial rents have far exceeded it, for example. I think another piece of context is, it's like going to the supermarket and you have your coupons that you cut out of the newspaper. The face price stays the same, but you get the buy 3 and get 2 free, or you get the 20% off coupon. And there's something similar that's been going on in the office sector. It's pretty common to offer concessions, and those maybe normally, pre-2020 would have been 20 to 25% of the value of the lease. Now it's more like 30 to 35% of the value of the lease. There's a lot of variability there. That's one of the things that's been going on. So we'll see what happens with how rents start responding to where you might think they should be, given vacancy. I think there's arguments on both sides. So the argument that rents are going to start falling is really a basis argument. In other words, the more properties transact at discounts to their previous valuations, then the more flexibility those new owners will have to compete by lowering face rents. And I think because of that, we are likely to see rents dip some in 24. On the other hand, the tenants who have been in the market, those that are willing to commit to space, that are willing to commit to term, they don't seem to have been terribly price sensitive. So the slice of supply that is truly relevant to them and truly competitive, they've been paying premium rents typically. And so that's the argument for rents may actually not respond as much as you might think to increasing vacancy, because after all, if you're looking for some premium first generation space, it almost doesn't matter how much, Class B space in office parks is available. That's not really where you're playing. So I think it'll be interesting to watch that play out. Yeah.
And even if it is Class B, for example, then you probably want nicer space, right? That's going to be more expensive to build out and produce with more amenities, right? And then maybe as a tenant, you're taking less space. So maybe your budget is, okay, well, we can go with smaller space, but nicer, right?
Yeah, that's right. So if you can go to, premium first generation trophy asset, maybe take 20% less space, pay 10% more for it on a per square foot basis, get a generous TI allowance, maybe kick in some money yourself. Then your total occupancy cost is about the same, and you've got an office that maybe is going to work better for you. So, so that's definitely something that we've seen. Now, I'm of the mind that we could be coming to the end of that. I think with interest rates that they do look like they've stopped rising, knock on wood. But they are higher than they were, and that means the cost to finance those tenant improvements, regardless of who's paying for them, is higher. And so I think this couponing game, this offering concessions in order to hold face rents high, I think there's a limited ability to keep doing that. And so I expect that we will see, because of that and because of what I mentioned with new basis owners coming into the market. I think we're going to see face rents fall.
Mhm.
I think we're going to see tenants perhaps start preferring some of that second generation sublet space, of
Mhm.
which there's still a great deal on the market. And in fact, in the Great Recession, that's the space that really led the recovery. It
Mhm.
was that second generation, 5 to 10 year old inventory that at the beginning of the Great Recession, tenants gave a bunch of it back. But by 2011, when the recovery started, they started reabsorbing that.
Yeah.
So the first part of that happened again in 2020. It's that second generation space that the tech companies were acquiring at really high rates in the late 2010s. They started giving that back. They started putting it on the sublet market. A lot of it's still there,
Mhm.
and we just haven't had that recovery start.
Yeah.
So I think as we move forward and get more toward the bottom of this shakeout, I think that recovery will start.
Interesting. As you're considering, and the audience is considering future demand for office, how much do you take into account the job market and what's happening there, and how it impacts companies' ability to get their employees to come back in the office?
Yeah, it's
Mhm.
certainly remains the key demand driver, right? I think it's been dislocated, the relationship, but it has not been destroyed. And
Mhm.
even if you look at the last 4 years, the periods of time when absorption has been most negative
Mhm.
have been mid 2020, when lots of 2.5 million office workers lost their jobs in 2 months,
Mhm.
and then again in kind of mid to late 22 and early 23, when we had a wave of layoffs, mostly focused in the tech sector, with some in banking as well. Um, Now, the difference this time is that, other than those two periods, we've had very quick job growth, especially in the traditional private sector office using industries. And 21, early 22, 5-6% a year, historically strong job growth. And it took that 5 or 6% to bring absorption back positive, right? And so that's just an indication that the relationship is still there.
Yeah.
It's just been dislocated, and we're still seeking it out. So I think there's multiple perspectives on where we go from here.
Mhm.
If you look at the indicators of people returning to downtown central business districts, people returning to offices, there are lots of those indicators out there. A couple of my favorite, Placer.ai, is a mobility data tracking provider, and they've tagged several hundred office buildings where they're capturing people with their mobile devices, entering and staying the area of an office building.
Mhm.
And they're showing that about 60% or so on average versus 2019 is where office attendance has been. And that was pretty consistent throughout the
Mhm.
whole year. Similarly, there's a survey run by Professor Nicholas Bloom out of Stanford University, the survey of working arrangements and attitudes. And according to that survey, they ask about 10,000 workers every month about their working arrangements.
Mhm.
Very similarly, they say, well, we're in the office about 3 days a week, 60% of the time.
Mhm.
You can add maybe 10, 12% to that for, peak days. We definitely see this midweek peak pattern. So is there more upside risk to people coming back with greater frequency? Sure, there is. We were talking before we started about UPS, big Atlanta employer, making a push for greater attendance starting in March of this year. There are other examples of that. So I think we probably will see attendance increase. I think the other side of the argument, though, is that we're actually looking, if you believe the economic forecasters like Oxford, which is who we use at CoStar, we're looking at a period of much lower average job growth in the next decade or so, probably less than 1%,
Mm.
whereas over the last 20 years or so, at least in expansions, we've seen something that looks more like 2%. So I think that's the other side of the coin is, given that the relationship actually still does exist between employment and demand for office, if we're growing the employment base slower, then even if those existing employees do start attending with greater frequency, to what degree does one prevail over the other? To what degree do they cancel each other out? It's not really easy to tell. I think what I go back to is what we've seen in the leasing market, which is over the last 4 quarters, we saw a very consistent trend of tenants still willing to commit to term or being newly willing to commit to the kinds of terms they did pre-pandemic, but taking less space. So as we work our way through the remaining 45% of pre-pandemic leases over the next couple of years, then I think we'll see that relationship really reset, and we'll be able to forecast with much greater accuracy.
Yeah, that makes sense. And as our audience knows, we're talking kind of broad brush here about office, but it really comes down to specific building, submarket, and market, right? Class of property. 'Cause one of the things that we've seen selling office buildings is when we sell buildings with a lot of small suites, a lot of those businesses, they're in there occupying, they're using those spaces, and those buildings are being used. We sell some buildings with very large corporate tenants. They seem to be having more trouble getting folks, back to the office. And interesting, you mentioned UPS, a big employer like that saying, "Hey, we want you back 5 days as a week." How fast does that help the market? And my question to you then is maybe more geographic and more class. What do you see for differences between kind of a newer product and demand for the rest? And then what do you see for different geographic markets and cities?
Yeah, well, there absolutely are nuances. And I think first, if you think about asset quality, one of the things that we've learned is that it's really important to go a little deeper than Class A versus B versus C. And I've used the term first generation a couple of times as we've been talking here. And I think that's one of the key delineators. Buildings that have been constructed really in the last 3 to 5 years, they're on their first cycle of leases. Even today, a lot of the space that is under construction and soon to be delivered is pre-leased. There's a building in Boston, One Congress, delivered mid to late summer this year, essentially fully leased, million square foot tower. So there's demand for that kind of space as consistently as ever, 50 million square feet a year and positive absorption for, a decade plus now. One level below that is, and I'm not the person who invented this term, but I like it. It's commodity Class A. It's kind of, hey, this is a nice building, but there's nothing necessarily special about it. At least not anymore. It's that second generation to third and fourth, built in the, maybe 90s plus. That's the space that we're seeing a concentration of sublease. Subleases is down actually from its peak in the middle of last year. So I think that's a good sign. But it's still twice what it was in 2019. And a lot of that is concentrated in this commodity Class A space. And that's, by our reckoning, 25% or so of inventory is this, Class A, but a step below the trophy or the true premium space. And so in terms of a share of inventory, it's actually performed worse than the kind of Class B space. Although the total negative absorption over the last 4 years is pretty similar between the two, but there's just less of this commodity A. And so that, I think it's a really important distinction. And then geographically, absolutely there are differences. And I think, on one end of the spectrum, really in a class by itself, is San Francisco, which experienced the perfect storm of a market that's heavily dependent on, because of the concentration of companies and workers there, the tech sector, who were the ones who were most flexible at the beginning of the pandemic and continued to be in terms of their workplace arrangement. But then after that, that's where the slowdown in employment really started. In fact, employment in the information sector, which is where a lot of those companies are classified, it's actually negative over the last 6 to 9 months. Total office using employment is essentially flat since May of last year. But among the tech companies, it's actually negative. So it's kind of the double whammy there. San Francisco is highly exposed to both of those factors. And then, it's also a big city. It's expensive to live in. It's difficult to commute into. All of those things matter. Whereas on the other end of the spectrum, you take a market like Miami, um, that is not immune to those forces, but it has some resilience because personal and corporate in-migration from other places that
Mhm.
has buoyed the office market. Actually, didn't have comparatively a whole lot of supply in the office sector, and so that's helped their vacancy numbers as well. So it's one of the few markets where vacancy is actually flat to trending downward since 2020. There's some other markets, major markets, that have, at least from a demand perspective, held relatively steady. Houston's one of those markets. Las Vegas is one of those markets. Interestingly, Austin has seen positive demand, yet they've seen
Mhm.
also one of the largest increases in vacancy because there's just so much new supply there that is even still under construction. So that's kind of your classic supply demand imbalance there. But it's not really because of the demand side; it's more because of the supply side. So,
Yeah.
in general, I would say once you get past the major markets, the top 15 to 20, you know, you look at a place like Sacramento or St. Louis or Nashville. It's not that there aren't challenges to demand there, because there are. But in markets like that, you've got a tenant base that tends to be more locally focused. It's not going to be the third regional office of a global employer with 10,000 employees.
Mhm.
And those local tenants behave differently in terms of how they approach office space. And
Yeah.
so because of that, um, you don't get the same impacts in those smaller markets. They also tend not to have as much speculative development, just because precisely because they don't attract those the
Right.
third and fourth regional offices from major occupiers. So they stay a little bit more in balance, and we've seen that as well.
Yeah. One of the aspects that our audience sees in the office market is the difference between suburban and central business district. What's the trends you see there overall?
Well, there are differences.
Mhm.
I think it's a difference of degree more than kind. In general, the suburbs have performed, I'll say, less poorly from a demand
Yeah.
perspective. Um, Part of that is because if you think back to, it's hard to remember now, but if you think back to 2 years ago, beginning of 22, and we had a little thing called the Omicron variant come along, um, which really set a lot of things back, right? We sort of reverted temporarily to avoiding things like crowds and public transit.
Mhm.
And these major markets, these downtown areas that are dependent on public transit, they suffered because of that. The office buildings suffered because of that. Whereas in the suburbs, where you were already typically driving a car to get to work, you didn't have quite as much of that, habit formation and unformation and reformation that we saw impacting the major markets. The other thing about suburbs is they tend to be more commercially diverse. So you might have an office park or an office building, but that's going to be right down the street from a lifestyle center
Mhm.
or a group of restaurants or
Mhm.
some apartment complexes. They're not as a single purpose oriented as, say, downtown Manhattan or even midtown Atlanta,
Mhm.
for that matter. And so because of that commercial diversity, you have a sort of baseline of human beings walking around the place that are doing something other than just going to work in an office.
Yeah.
And because of that, it turns out that the office buildings do tend to perform better. So
Yeah.
that's another thing the suburbs have going for them.
Yeah. Yeah. It's nice to have an office where your employees can go do something pretty close, right?
Right. Yeah.
Whether it's
And
entertainment,
and the
restaurant.
retail itself isn't dependent on the office workers, right? It's
Right.
sort of the reverse of that. The
Right.
draw is, I'm going to come here to play,
Good point.
and I'm going to work here as well because it's convenient to the rest of my life.
Yeah. Now we're seeing some office buildings get torn down. We're seeing some get converted to other uses. We're also seeing kind of new supply and the starts are kind of stopping. So how does that impact the office market, and what do you think the timing might be there?
Yeah, so I have worked on the conversion angle with my counterpart at CoStar on the multifamily side. We've done some analysis of that, and sort of the line that we use is that conversions are transformative at the neighborhood level, but they're not really going to impact the overall market fundamentals on either the office or multifamily side. That doesn't mean that they're not a thing. They are,
Yeah.
and they're certainly increasing. Boston, where I live, has a government program that's offering a tax abatement for building owners who can convert office to residential. New York has looked at similar programs. Chicago, the federal government has even gotten involved and has sort of curated a bunch of existing federal programs and done some things to try to make transfers of title a little easier to facilitate conversion. So these things are absolutely trends, and they're going to be meaningful in the instances where they apply. The analysis that we did suggested that kind of the optimistic scenario is you're looking at reducing office inventory by 2.5%. And again, I think that's on the optimistic side. And on the multifamily side, you'd increase inventory by about 1%. Now, what the second thing you mentioned, which is construction starts, they were only about 31 million square feet last year, which is the lowest we've seen since 2010. And that's going to create this really interesting phenomenon in 2 to 3 years where, assume that demand for first generation space remains as consistent as it has forever, essentially, through the Great Recession, through the COVID recession, up to now. If in fact it does, we're actually going to run out of it, by the time we get toward the end of 2026. Historically, new construction is 2.5% or so of inventory, and that vacillates a little bit. It's never been below 1%, at least not in the last 25 years. And that's where we're headed by the beginning of 2027. And unless we start soon and build fast, then we're going to have actually a supply crunch in this kind of premium first generation space.
Beginning maybe 26?
Yeah, I mean, I think the market will start reacting to it probably in 26. So yeah, we'll see what happens. We could have this phenomenon where the vacancy rate is actually continuing to rise. But if there's 4% of the market is commodity class A or B plus space that is really irrelevant to the tenants who are actually in the market for space, it's not going to necessarily affect the price they're going to be paying for that premium space.
Yeah. Well, yeah, that should maybe shoot up some rents, right, in some of these markets if they want new buildings.
Yeah, right. I mean, it's a liquidity issue, right? It's similar to what we've seen in the capital markets, but in the leasing market, if you're not transacting in the middle market or down market, then those rents, you don't really know how much they're moving. Whereas if all the activity is concentrated at the top of the market, those rents may continue to rise. And so the net effect of that so far has been essentially flat. But that could change.
Yeah. Well, it's interesting. So if you're a tenant in a new first generation office building, you might want to be okay with a very long lease term, right?
Well, and so far tenants have been willing to do that because they have been getting the support of more generous concession packages. Right. So if you want I actually think it's the build out more than the free rent, although both have been available. But if you want that nice build out in premium space, then you've got to commit to term, and that's what they've been doing so far.
Yeah. Talk to us about green shoots, silver linings. Well, what do you see?
Yeah, well, one of them is what we were just talking about, right? Which is if you are in a well-capitalized position to own a premium office building, then you may do just fine. Now, you're going to do it by stealing market share. So this isn't the rising tide lifting your boat. This is you taking on passengers from the sinking boats. But you may be positioned to be just fine. I do think as well that one thing that's different now than say 2 years ago is even though we've got last year and this year that are going to look bad from a statistical standpoint when you talk about absorption and demand. But what we do have now on the positive side is the quality of occupancy now is much higher than it was 2 years ago. Right. In 21, even early 22, you had a lot of tenants kicking the can. They weren't really sure what they wanted out of their office space. And so they just, I don't know, I'll renew in place for 12, 18, 24 months. Mm-hmm. Well, now those are coming due, which is another reason why there are more tenants in the market. Yeah. And the tenants, they may be taking less space, but they're committing to it. They have in their mind a picture of what they want their workplace to look like. Whether that's 5 days in the office, whether that's 3 days in the office, whatever it is, they've got that picture in their mind and they're acting accordingly. So what that means is you can probably count on those tenants, barring a major economic catastrophe, you can count on them to be there at the end of the lease term. Yeah. Whereas a couple years ago, even the ones that were renewing short-term extensions, we would still see some of that space end up on the sublease market pretty quickly. Yeah. So I don't think we're all the way back to what we might think of as, normal underwriting assumptions for renewals and for tenants actually occupying and paying for the space for the full length of term. But I think we're a lot closer now than we were a couple years ago. Yeah.
Well, what would you leave our audience with, Phil, to think about for office in 2024?
But we've got more shakeout to come. It's not a simple one phenomenon impacting everything. One way to look at that is just look at the buildings that have transacted. We have a couple of indices that try to capture the change in values, and if you look at what we call our equal weighted repeat sales index. So this is treating every sale as kind of one. Every sale counts as an equal sale, and you average all those together. The values appear to be down, 12 to 15% or so, 10 to 12% from peak. Well, that's right in line with what you would expect if your cap rate goes from 7 to 8, right? And that's true across the commercial property sectors, right? So there is part of office that is behaving just like commercial real estate always has. Right. And that's because, a lot of what's been transacting has been smaller, relatively safe from a risk perspective, long-term lease properties. Mm-hmm. On the other hand, if you look at what we call our value-weighted index, which is more the multi-tenanted institutional grade, in the past we would have thought of it as, core office. Maybe now it's more value add. That index shows values down 25% or so. So there's something more than just the cap rate effect going on there. Yeah. There's all these effects of uncertain demand. Right. And so that's what I would leave you with is there's a lot of nuance out there. There's nuance across markets. There's nuance across the type of product. And there's nuance across, what's actually transacting, who's buying and why they're buying. Because there's not just a simple story going on. Yeah.
Well, you mentioned cap rates and we didn't really talk about it yet. So let's talk about that briefly. Kind of what are you seeing trend wise there? You just mentioned maybe 100 basis points increase in cap rates on the really high end properties. What else are you seeing?
Yeah. So one thing that typically happens historically is when you have an environment of rising interest rates, then those rates have to stop rising. And then what happens is cap rates tend to keep rising for a little while. And the reason is because you need some certainty about what your risk-free return is going to look like before that risk premium can kind of adjust. Right now we've got still probably a compression of the spread between real estate cap rates and say the 10-year treasury or the triple B. So I expect that we're going to see more cap rate expansion. How much is going to depend. And frankly, we may actually not see cap rates expand much more on those kind of, I'll say air quotes, safer deals. Yeah. But if you think about some of the distressed properties or the foreclosure sales that are starting to happen, I mean, those aren't really cap rate deals, right? So
more price per pound,
yeah, more price per pound. So replacement costs, So we on average, I think we may see some expansion, but where cap rates are actually relevant, maybe not as much as kind of the total fall in values that we anticipate, which, I think we are probably looking at 30 to 40% on average from peak. But what that looks like for cap rates, if you're out to buy a stabilized property, maybe not quite what you think.
Yeah. And I lead a team that sells office buildings in the Southeast mainly. And, we're seeing the smaller buildings where maybe owner occupants or partial users buy them. We're not seeing those values plummet as much, on the street here, if you will, as we are the really large buildings. I'm selling a really large building, and it's like I'm hearing fallen knife. No, watch out. They really plummeting values. You're seeing something similar as you track it at CoStar when the smaller ones versus the larger buildings.
Yeah, well, I think it has to do with the vintage of the lease, for one. The vintage of the loan, if you got a loan, certainly. But the vintage of the lease. So if you've got a large multi-tenanted building and a lot of your rollover exposure comes from leases that were executed before 2020.
Yeah.
And I think that's a very different situation, certainly than a single tenant.
Right.
But even if you've got a recently constructed building with, leases that were signed 21, 22 last year, that's that quality of occupancy. That's just a different situation.
Yeah. Good point. Yeah.
So I think you're going to start to see some of those nuances play out as well.
Yeah. Well, that's interesting you mentioned that, because I naturally think about that when I'm looking at the rent roll and I look at the move-in dates and I say, well, this is before COVID, so do we really know? That's
right.
But when I see past COVID, I'm like, okay, well, maybe they're a little more secure in what they're doing.
Yeah, and even looking at something like the FDIC's loan workout guidance, some of the examples they provide they essentially suggest that if you've got low daily attendance and a lot of lease exposure from these older leases, then you got to discount that. You can't, as the lender even, you can't just kind of wink and nod and extend. You've got to have a stronger basis for that. But it's a totally different situation if you've got tenants that have committed to the space in sort of this new normal, right? Because they're going to use that space. That's why they took it on. Yeah.
Well, it's interesting to see some of these prices per square foot being so low on some of these buildings, and it makes sense. I get it, but when you think about them getting maybe a building at $60 a foot, to buy it, and the replacement cost is what, $560 a foot? I don't know. Be new, but I mean, it's pretty amazing what people are getting these prices.
If you can get an office building for $60 a foot, and let the type of buyer that we've seen out there on the smaller end of the market, maybe they're cutting a check for $5 million, $10 million, $20 million. But at that price per pound, you can probably make it cash flow at 70% occupancy, right? So you don't even necessarily have to have a great plan if you're willing to take the risk. Although I'm sure a lot of those buyers do have a plan, right? They're going to do something, once the capital environment changes.
Yeah, they do. And I think it's going to be amazing. 2024, I think, is going to go down in history as an interesting time to have bought office properties because of the risk, right? And the low prices and the high interest rates that we have at the moment. So it's going to be interesting to see. And Phil, great information as usual. Thank you for joining us, sir.
Yeah, it's a pleasure, Michael.
All right. And thank you for joining us around the country. We sure appreciate it. And we appreciate you sharing the show, commenting. Please connect with us on your favorite social media. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. And by Lument. For senior housing, healthcare, and multifamily financing, visit lumet.com. For more podcasts and videos, subscribe and visit creshow.com.